Welcome, market enthusiasts. Today, we plunge into the heart of the Nasdaq 100, the index that houses tech giants and innovative disruptors. It's a powerhouse, a beacon of progress. But beneath the surface, whispers abound about an invisible hand at play, an undeniable edge some wealthy individuals exploit. We're talking about insider trading techniques, not just rumors, but sophisticated strategies used by those who seemingly defy market logic. This isn't about luck, it's about privileged information, and it profoundly shapes fortunes on the NDX. So, what exactly is insider trading in this high-tech arena? Simply put, it's leveraging material, non-public information to make advantageous trades. On the Nasdaq, where company valuations can swing wildly on news, this information is pure gold. Market reports consistently highlight how even a few hours lead time on a major announcement can translate into astronomical gains. It's a violation, yes, but regulatory bodies concede it's incredibly difficult to prove, especially when techniques are refined to appear legitimate. It creates an undeniable advantage for those in the know. The kind of information used? It's not just about a pending merger, although that's huge. Analysts point to a spectrum of critical data. Think about pre-release earnings reports, unannounced product launches, confidential regulatory approvals, or even major contract wins or losses. Imagine knowing a tech giant is about to secure a multi-billion-dollar government cloud contract days before the public. This isn't just theory, it's the daily reality for some, transforming what would be a risky gamble for others into a near-certain windfall. This informational asymmetry is the foundation. One common, yet hard-to-pin-down technique involves pre-announcement volatility plays. Traders with advanced knowledge purchase significant options or shares just before a major corporate announcement, say, an acquisition target for an NDX component. When the news hits, the stock price surges, making their options skyrocket in value. While regulators watch for unusual trading volumes, clever traders often spread their purchases across multiple accounts or use obscure derivatives to obscure their tracks. It's a game of stealth, maximizing impact while minimizing detection risk. The profits can be astounding. Consider the archetype of the well-connected executive. This isn't always the CEO, but often a senior manager, a board member, or even a legal counsel at an NDX-listed firm. They gain access to sensitive discussions about mergers, strategic pivots, or impending financial results. They might not trade directly, instead subtly communicating signals to trusted intermediaries, family, friends, or even through offshore accounts. Their vast network and proximity to decision-making grant them an unparalleled advantage, turning market shifts into personal wealth. It's a potent, often subtle, form of information leakage. Here's a more sophisticated technique, exploiting supply chain or partnership intelligence. Imagine a wealthy trader with contacts deep within a major NDX component's supply chain. They learn that a crucial, exclusive component order has been massively increased or abruptly cancelled before the market ever knows. This indicates a huge upcoming product launch or a catastrophic production delay. This granular, pre-market data offers immense leverage. It's not about public announcements, but structural shifts. This micro-information is incredibly potent, often flowing through less scrutinized channels. Then there's the shadow network financier. This individual, often operating from a sophisticated hedge fund or private equity firm, cultivates an extensive network of contacts across various industries connected to NDX companies. They piece together disparate pieces of non-public information, not from a single source, but from a mosaic of friendly industry professionals, consultants, or even disgruntled former employees. This network allows them to forecast trends in company performance with uncanny accuracy, placing large, well-timed bets that generate monumental returns. It's truly a masterclass in information arbitrage. Regulators, like the SEC, are always playing catch-up, employing advanced algorithms and surveillance tools to detect suspicious trading patterns. They scrutinize unusual trading volumes before major news, look for connections between traders and corporate insiders, and analyze communication records. Yet, proving intent that the trade was based on non-public information remains a formidable challenge. Wealthy traders often use sophisticated legal defenses and layers of anonymity, making prosecution incredibly difficult. It's a testament to the ingenuity on both sides of this constant, high-stakes battle. The stakes couldn't be higher. For those who execute these insider strategies successfully, the financial rewards are monumental, often propelling them into unimaginable wealth. However, the integrity of the entire market rests on the premise of fair and equal access to information. Insider trading fundamentally erodes that trust, creating an uneven playing field. It's a continuous ethical dilemma, the pursuit of extreme wealth clashing with the foundational principles of a fair market. The NDX, for all its brilliance, is also a battleground for information supremacy. And there you have it, a glimpse into the sophisticated world of insider trading techniques on the Nasdaq 100. From pre-announcement volatility plays to exploiting intricate supply chain intel, the strategies are as varied as they are cunning. While regulators fight to level the playing field, the pursuit of an informational edge remains a powerful, often illicit, motivator for some of the market's wealthiest participants. The NDX continues to innovate, but so do the methods of those seeking an unfair advantage. It's a fascinating, complex dance of data, power, and high-stakes finance. Keep watching the markets, everyone.